As a Canadian incorporated business, you want to be compliant with the CRA, and here is what you can do. Start with organizing your business so that your documentation is accessible for longer than a period of 3 years. The CRA says that the maximum reassessment period for a corporation is 3. However, when they think that there is the potential for tax fraud, the period that they can go backwards is actually indefinite. And what happens is, if you think that after 3 years you can discard your documentation because they can't ask you for it, but they do come to you for something that happened 6 years ago, if you cannot produce the documentation to back up anything that you've claimed on your T2 return, then you will be reassessed and the CRA will be deemed accurate and correct, and likely you will have to pay some taxes back. So it's important that you understand that if you can set up a system where you can have your files and documentation retained for a period longer than 3 years, even greater than 6 if that's possible, it will be better for you in the long run in the event that you need to access it. We also, of course, know that many things have moved to digital, and it's so important that you build a digital framework that allows you to have quick and easy access to the information you need, whether it's for yourself, your tax experts and advisors, or for the CRA if they have questions about your return. Now, what can you do to try to avoid some of the common audit triggers that the CRA has? The CRA is looking for large and unusual swings in expenses. So if your advertising expense in any given year is typically $1,000 per year, let's say, and all of a sudden it spikes up to $15,000. These are the types of things that catch the CRA's attention. So it's always important to note that. If you make a request to reclassify income, and why someone would want to do that is to shift income potentially from passive to active business income so that it is eligible for the small business deduction. That is not permitted and is against the Income Tax Act. They're also looking for shareholder loans. So very common for shareholders to take loans out of their businesses, but the CRA has very specific rules about repayment. Those loans have to be paid within 1 year following the fiscal year that the loan was taken. If you do not repay the corporation, because remember, the corporation and you as an individual are two separate and distinct entities. So if that loan is not repaid, there are income attribution rules that get passed over to you as an individual for the balance of that loan. They're also looking for changes in income streams and patterns. They're looking at related party transactions. And why? Because if you have related parties and you all have corporations, you might find ways to be able to all take advantage of the small business deduction credit, which is not allowed. Lastly, of course, they're looking for things like high revenue but very low profit and the consistency of losses over a certain period of time. Another item that comes to mind is income splitting. If you are employing family members within your business, you have to follow the tax on split income rules and ensure that whatever salaries you are paying to relatives, they must be working within the company, and that the wages are reasonable that you would pay to someone who was not related to you. So these are just some of the different areas and audit triggers that the CRA is definitely paying attention on.